We had the swearing in of Jay Powell. He's coming in at a time when a lot of people are saying, look, up until now, it's been Goldilocks here, right? We've had low inflation. Jobless rate is now at a 17-year low. Stock markets were rising up until the last couple of days. Now it seems like the markets might be testing things at this point. Do you think Jay Powell's job is about to get a lot harder?
Well, I think we've all been waiting for the last several years, 6 or 7 years, for inflation to start coming back up to our 2% target. On Friday with the jobs report, we saw a little hint that wages might finally be rising. That's a really good thing for the country. It's a good thing for workers. We need to see what's going to happen with inflation. Now, as you know, we have our 2% inflation target and our maximum employment mandate. Sometimes those are a seesaw, trading off each other. We want to see inflation build back to our 2% target. And I think Jay, with his 5 or 6 years of experience at the Federal Reserve as a governor, is very well equipped to take this on.
Right. But, Neel, you dissented at the last 3 meetings, saying that we should not be hiking rates. So this wage increase that we're starting to see at this point, does that make you change your position?
Not yet, but it's an indicator. I want to pay very close attention to the data. I was paying attention to the data before, saying, why are we raising rates? Now, with the market-based measures of inflation expectations creeping up in the bond market and some signs of life in wages in the employment report, that says, okay, let's pay attention to this. Let's see if it's real. It could be a blip, but let's not ignore it.
Okay, you say not yet. So when?
Well, we need to see more data. Remember, we have a symmetric 2% target, and we've been consistently below our target for 6 or 8 years. So if we go above our target a little bit, that shouldn't be any more concerning than us being below target. So I don't think any of us are seeing any urgency to slam on the brakes, but we do need to pay attention to the data.
Well, this target, I'm curious, because, the voices are growing in some ways, Neel, about whether or not this inflation target, this 2% inflation target, is actually sustainable. Should the Fed be looking at a range instead? What is your view on that?
Well, I think that if you look at literally what a symmetric 2% target means, I interpret it as achieving 2% over time on average. So we'll be a little bit below sometimes, we'll be a little bit above sometimes. You can't fine-tune it too much. I don't see a range as buying us that much more than having this symmetric target.
Why not?
If we're really willing to allow inflation to climb above. So we've been at about 1.5% inflation for 5 or 6 years. In theory, if we have a symmetric target, we should be willing to go up to 2.5% inflation for a few years and then average over time. That's how I interpret it, but I'm certainly open to having the conversation with my colleagues to explore alternatives.
Do you get a sense, Neel, at all that wage inflation might, as we say, we're starting to see it pick up. Do you think it might get to a point, though, that by the time we recognize it in the data going forward, it might be too late?
It's certainly possible. I don't want to rule that out, because we know monetary policy operates with a lag.
Right.
But we're not actually providing that much accommodation today. Because the committee has raised rates several times in the last couple of years, if you look at whether the neutral real interest rate is, it's still very low, or at least we think it's very low. So we're probably only providing about 50 basis points of accommodation right now, maybe 75 in that range, relative to neutral. So we don't have very far to go to be at a neutral or stable monetary policy.
But at this, I want to clarify, Neel, if you were voting this year, would you be voting for the 3 hikes that it seems like the markets are pricing in?
I need to see the data. So I've taken a policy of never predicting and saying how many hikes I think we should have. I want to see what the data provides us. And if I want to see inflation climb back to our 2% target, I want to see wages climb back to we have a sustainable economy, not consistently undershooting. Those are going to be the measures that I'm most focused on in determining whether or not it's appropriate to raise rates.
Why do you think the 10-year yield is going up so fast over these last few weeks?
Well, it seems like people are pricing in that the tax cut is going to have more of a near-term stimulative effect than maybe we appreciated a few months ago. So that's something I want to look at. And then longer term, I want to see, is the tax cut merely short-term stimulus, or does it provide any long-term supply-side benefits? I think we're uncertain about that yet. I have been surprised by how much optimism the tax cut seems to have engendered amongst all of my contacts around our district. Optimism could lead to more investment. It could lead to more activity.
Why are you surprised? Why are you surprised?
Well, I don't know. I mean, I think that people saw the tax cut coming. There was some sense that Congress was going to come up with something in the last few months. But when I've talked to our directors and to their contacts, it really seems like people are quite excited by the tax cut and now excited by the fact that companies are paying one-time bonuses. Is that going to translate into real additional investment? I don't know yet, and they don't know yet. So we need to wait and see.
Neel, seeing how yields have risen pretty quickly these last few weeks, or last week, in fact, stock markets deep in the red these last two trading sessions and going forward, it seems at least as indicated by some of the futures trade, has the risk of recession increased here?
Well, one of the recession risks that I was looking at was the flattening of the yield curve. The yield curve has now steepened a little bit. So that's a good news sign, as opposed to stocks falling and the Fed pushing up the front end and the back end being anchored. That would be more concerning to me. So the fact that the yield curve is steepening a little bit, I think takes a little bit of pressure off and says, okay, if the bond market is seeing inflation expectations creep up, that may give the Fed a little bit more room to tap the brakes if necessary, if the inflation actually materializes.
But, we had Alan Greenspan on about a week ago who talked about asset bubbles, right? And he said, look, I see bubbles in stocks and bonds right now. Would you agree?
I think that's probably taking it a little bit too far. I mean, certainly valuation does seem on the high end in terms of the stock market. We'll see. We'll see. Maybe this tax cut will lead to stronger earnings growth. If you just look at the cutting corporate taxes pretty meaningfully, that has a big drop to the bottom line, and stocks could be pricing in this higher earnings per share. In addition, if the bond market and the stock market are pricing in lower long-term yields, that also could be leading to higher valuations. And so I don't see a financial crisis on the horizon, but we are paying very close attention to it.
What do you think is the biggest risk right now to the economy?
It's hard to say. Oil prices could be, if oil prices take off, that could be a big shock, a negative shock to economic growth. The dollar, I think, is going to put some inflationary pressures if the dollar continues to trend down. So these are all things. But at the same time, we're seeing growth all around the world. Europe seems to be doing better. Japan on the margin is doing a little bit better. That's a pretty positive overall global economic environment to be in. So right now, I would say the risks are roughly balanced. And hopefully we have slightly stronger inflation. Hopefully we have stronger wage growth. Those will be good problems to have for the Federal Reserve.
Staying on that wage growth theme for one more moment, though, Neel, do you think that if we continue to see this acceleration in wage growth, are companies going to take that acceleration and transfer it over to higher prices, higher consumer prices? Do you think that's going to happen?
I would, in some sense, I hope so. When I go around and I meet with businesses, the first they say, well, we can't find workers. So I always ask them, well, are you raising wages? And usually the answer is no. And I say, well, why aren't you raising wages? They say, well, we can't pass those price increases on to our customers. That, to me, is an expression of anchored inflation expectations, or people expecting inflation to be very low. So to me, if we see businesses raising wages, not just one-time bonuses, but actually raising the hourly rates and then starting to pass that on to consumers, so that inflation builds towards our 2% target.
Right.
That, to me, will tell me, all right, we're achieving our dual mandate that Congress has assigned us. And, the Fed has very powerful tools to keep inflation from getting too high. We have very limited tools if inflation continues to run low. And so that, in some sense, is a good problem for us to have.
Do you get this? Do you feel at all, Neel, though, that we need to be rethinking some of our monetary policy tools, given what we've experienced with this low unemployment, inflation, a mystery? Where's the inflation growth? We may be seeing the end of that, end of that mystery now. But should we be rethinking completely some of the monetary policy tools of the Fed?
I don't think so. I think we need, again, when I look at our 2% symmetric inflation target, I believe we as a committee have been treating it as though it's a ceiling. Every time inflation starts to creep up, we tap the brakes and say we're not going to let it go up any higher.
And you're saying it's okay to let it go a little higher?
A little bit higher, right? If we've been at 1.5 for 5 or 6 years, then in theory we should let it go to 2, 2.25, 2.5, and shouldn't be any more concerned about that. As long as we are completely committed, and we are, to keeping inflation in check over the long term, these minor variations around 2% should not concern us too much. So I actually think we have more flexibility than we've been willing to admit.
And putting on your markets hat then, do you think we put too much emphasis on where the 10-year yield is, where it ends up, the 3% level? Do you think there's too much focus on that level too?
I think in general there's too much focus on short-term data. So, just look at the wage data that came out. It's one data point. And others have pointed out that the average hours that workers worked actually went down. So the total take-home pay for workers wasn't so high as the 2.9% hourly earnings growth suggested. As a general rule, I think we need to look over the longer term and look at a broader range of data and not be too focused just on the 10-year today or hourly earnings on one data point.
Neel, before we go, I know you tweeted out some nice words to Janet Yellen. She gave an interview over the weekend where she did express some disappointment that she wasn't she wasn't renominated for 4 years. Do you think Janet Yellen deserved 4 more years at the Fed?
Well, I said so publicly beforehand. I thought that she's done an outstanding job and is an A-plus public servant, however anybody looks at it. But at the end of the day, it's the president's call, and every president gets to make his own appointment. And I think that the president made an outstanding choice in Jay Powell. I've had the privilege of working with him for the past 2 years. I think he's got great experience. He's not an ideologue. He's very pragmatic. He's a consensus builder. I think he'll do a great job. Tell
me one thing you've learned from Janet Yellen that we don't know.
You may not know this about her. She has excellent interpersonal skills. Sometimes people don't assume that economists who are very technically savvy will have the best interpersonal skills. But Janet made a point before every FOMC meeting of calling every Fed president and every governor individually to talk about our outlook for the economy, our outlook for monetary policy. She ran very efficient FOMC meetings. She was exceptionally well prepared, and she worked very hard to build consensus. And I know everybody appreciated the care and the time she put into that.
So, Neel, let's talk a little bit about overseas, central bank policies in Asia and in Europe, but particularly in Asia. You've talked quite a bit about the BOJ and some of the lessons learned there. What do you think we're learning right now, or what are you learning from the BOJ and the Japan experience?
Well, in America, people were very quick to criticize the Bank of Japan, saying they should have been much more aggressive trying to deal with low inflation than they were. I think we at the Fed are learning it's not so easy. We may be in a low inflationary environment for a long period of time, and we've seen the struggles of Japan. One of the things I've learned from Japan is how powerful low inflation expectations are when they become embedded in a society. Mm-hmm. A central bank can raise inflation by 10% or 100%. We don't know how to raise inflation expectations by 0.5%. That's the trick. And I think Japan has learned that. They've taken extraordinary measures to try to boost inflation in their economy, but they overall want to still maintain credibility. So I think we at the Federal Reserve need to continue being humble, look at the Japan experience, and we certainly shouldn't declare victory too early on inflation. We've seen from Japan how painful it is if one does that.
And that's true. I mean, it's inertia, right? And as you say, going from 0 to 1 is way harder than going from 1 to 100.
Exactly.
As you mentioned. What do you think, Kuroda has such a tough job ahead, but, he's said very specifically, we are going to keep our foot to the pedal, and we're going to continue that stimulus. How do you think Japan gets out of this low inflationary environment?
Well, one of the challenges and I wrote about this actually in an op-ed, is population growth. Right? Japan's demographics, America's are challenging, Japan's are much worse. And Japan does not have the history of immigration the way the United States has. Mm-hmm. And so a challenge for Japan is, can they open themselves to immigration? Can they help to boost that fertility rate, either domestically or by bringing in more workers from abroad? And we in the U.S. need to recognize that immigration has been a real source of strength for our country, and it needs to continue to be a source of strength for our country going forward if we want to overcome our own domestic demographic challenges.
And Neel, some of the challenges for these Asian economies has been their own rising currencies vis-a-vis the dollar, right? And it's been such a mystery, I guess you could say, or confusing or confounding that the dollar has fallen in the rise of rising rates here in the U.S. Do you see that trend continuing, and what kind of impact do you think that is going to have in Asia?
Well, honestly, it's hard to know. I talked to our own economists here at the Minneapolis Fed, and
what do they say?
They say we have no idea. That we're all terrible at predicting currencies, and the currency markets have their own minds. I would expect to see. I'm hoping that just a strong global economy will help all of us. It'll help the U.S., it'll help Asia, it'll help Europe. Whether the dollar goes up or goes down from here, I don't know. But certainly a falling dollar makes it more challenging, or easier for us to hit our inflation, harder for Japan to hit their inflation target, and harder for Europe to hit their inflation targets. And so I'm hoping that strong productivity growth and strong real economic growth can boost all of our economies as opposed to just one-time currency movements.
Is there a risk, though, that you see where there's going to be eventually a real separation here between what the Fed's doing, which is hiking rates, and what other central banks in Asia or elsewhere, what they need to do to keep their currencies down, which is staying on stimulus?
It certainly is possible that there could be a divergence in monetary policies. We're not targeting the dollar at the Fed as we adjust rates. We look at our dual mandates of prices and maximum employment. But I would be surprised. Our economies are interlinked enough that I would be surprised if, at the end of the day, there are wildly divergent monetary policies. It just seems like the linkages are tight enough that there will have to be some alignment. Otherwise, you're right. We're going to see huge movements in the currencies, which will end up just working against us.